So now you've seen some pretty cool ideas of how we can strategically use naked puts and naked calls to leg into our stock trades. Specifically, we use a naked put to leg into a long stock, and we would use a naked call or an uncovered call to leg into a short stock position. Let me show you one that might surprise you. How many of you guys know about a little guy who's kind of well-known, big investor, one of the richest people in the world, named Warren Buffett? What if I told you that he actually uses this strategy and makes billions of dollars with it? Let me show you how Warren uses it. Here's what Warren does. Here's how you use naked puts Warren's way. First of all, analyze the stock Warren style. So all of you who've been followers of Warren Buffett for all these years, you understand it's a value-based model of investing. You're simply going out, you're looking at all the fundamentals, and when you find a company that you feel like, man, if this company's trading at that price, that's a really great value, I'm going to go buy it at that price. Okay, so that's Warren's style of investing, and if you are a follower of Warren Buffett, you certainly understand that style of investing. Okay, so we're going to analyze it the traditional Warren way. Next, we're going to determine the price that we are willing to pay, part of the strategic trading plan that Warren would set forth, right? He's going to say, okay, here's the value. If this stock drops to this price, I'm willing to buy up a whole lot of it because I really believe this stock is going to go up. And by the way, when he does that, he's in. And you guys understand this. Once Warren makes a decision, he says, I've made my decision. I am going to stick it out for the long haul. So he's willing to be in this trade for a really long time. He's committed to it. Now watch what he does. He sells a naked put at that strike price. So whatever the strike price is, if we went back to our Apple example, it would be $95 or $92.50 or whatever. And he'd say, if Apple gets there, then I'm willing to do it. Well, since he's willing to stick with it for a long time, he sells as much time as possible. This breaks one of my rules. I say sell as little time as possible. Warren says the opposite. He says, I'm willing to stick with this thing, so I'll sell as much time as possible. He'll sell a year, 2 years, even 3 years of premium, really long dated, what we call leaps options. He'll collect all that premium, and he's obligated to buy at the price that he's already determined is a great value for that stock. He's going to collect as much premium as possible, and in the process, he's going to make billions of dollars. That's Warren's way to using the naked put. So let me show you. Let's look at Apple here. The numbers that we looked at in the last video were 95, 94, 92.50, and the premiums we would receive were between 66 cents and $1.17. Well, what if we did it Warren's way? Warren would go out at least a year. So here we're 515 days in the future, and look at the premiums. Now, because Apple did their weird 7-for-1 stock split, you have these really weird option prices, $95.71, $94.29. They're totally fine to trade. You can actually trade these, no big deal, but they are weird strike prices, and it's only because of the split. And so these options split at the same time there. But look at the premium he receives. Instead of receiving $1, he's going to receive $11.30 for the 95. He's going to receive $10.60 for the 94.29 and $9.90. Now he's obligated for a really long time. He's obligated in this case for 515 days. But remember, what's Warren's philosophy? Warren's philosophy says, once I've decided on a price I'm willing to pay, that price is good indefinitely. He's willing to take the drawdown on it. He will hold it as long as it takes for this trade to eventually come into what he considers his fair market value. So let's say that Warren determines, hey, I'm willing to pay $93 a share, and he looks here and he says, okay, I'm going to sell this 92.86 put option. He's going to receive $9.90 right up front. And that money is going to be his. If the stock goes up, he makes $9.90. He never even bought the stock, but he made $9.90. Stock stagnates in 515 days, it goes nowhere. Still made $9.90 per share on the trade. And what if the stock comes down? Warren's going to buy the stock, in this case at $92.86, just below his $93 price point. And he made $9.90 in the process. Let's look and see how this works out here. So doing it Warren's way, he sells the 92.86 put. He receives almost $10 a share. What do we say, $9.90? So almost $10 a share that he receives. His cost basis goes down $10. Instead of having a cost basis of 92.86, his cost basis goes down to 82.86. So you tell me, if you're Warren Buffett and you say 93 is a great price, Now you've got the opportunity to make an extra $10 along the way and lower your cost basis to $82.86. Is Apple a good deal at $82.86? Heck yeah. I mean, that's $10 cheaper than I was willing to buy it for. And all we've done here is we've sold a long-dated or a long-term, what we call a leaps option, for that individual strike price at which we said we were willing to buy Apple. That's the way that Warren does this. Now, over time, let's look and see what happens here. Here's the difference in our break-even analysis. With the 30-day naked put, the short put here, our break-even was going to be $93.83 because we received $1.17 in premium. Remember, that was our maximum reward, was $1.17. Well, for Warren, he received almost $10. It was $9.90, but for easy math, we made it $10 here. His break-even drops all the way back here to $82.86. In other words, the stock, he could be totally wrong for up to $10. The stock could come down and get stuck, and maybe 3-4 years in the future, it's at $82.86, and he's like, well, it didn't work out for me, but he still made a little bit of money along the way. That's the way Warren Buffett uses this strategy. And again, for some of you who are long-term traders, maybe you're already a philosopher, a follower, I should say, of the Warren Buffett philosophy, and you like to buy stock with that philosophy, that really long-term picture, this is a really great way for you to consider lowering your cost basis right on the front end.